The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello and welcome to tackletrading.com. This is Trading Coach Gino bringing to you what the death cross in trading means. It's called the death cross trading signal. What it means, what it tells us, and how do we use it? So what is the infamous death cross signal in charting? The simple meaning is when the short-term moving average crosses a longer-term moving average. So if you're not familiar with moving averages and what that is, please review our video on moving averages. So basically a short-term moving average is usually an average that is 50 days or less. That would be your shorter term moving averages. An example of this, some very popular ones are the 5-day, 8, 13, 20, or even as much as a 50-day moving average. Now your longer term moving averages would usually be 100 days or 100 trading periods or more. The most common used are 100 and 200. And I also seen a lot of traders using a 150-day moving average. So the cross happens when you see the short-term moving average crossing down through the longer-term moving average. That's what creates the cross, otherwise known as the term the death cross. And a most popular one, once again, is usually the 50-day moving average would be crossing down or downtrending and crossing through the 200-day moving average. It can be used as an indicator not only for stocks, but I use it for funds, exchange traded funds, commodities, and especially the indexes. Now, what's the significance of it? How do we use this? Well, when the cross signals, the cross crosses down, when you see the death cross, that's usually could be many things. Usually it's a start of a bearish trend or a downtrend, we call it. Or it can be reaffirming a short-term bear trend is confirming that there's more momentum to the downside, that it's going to get even more bearish. Now, just so you know, as a note, like most indicators, it is not 100% accurate, but it's a very secondary lagging indicator. Now, I want to stress the word very, because it's a lagging indicator. It's using past data. And often it could be a false signal. Also, it's believed during the death cross, the trading volume after the cross is even more meaningful and makes it more accurate. So let me give you a couple examples. Let me bring up, the first one I have here is Disney. Disney, Walt and Company, you can see here trading at 115. That's the high of the chart. And what I have here is a 20-day, there's your short-term moving average. And as it's coming down, look as it crosses through the dotted line here. That's your longer term 200-day moving average. So the 50 is coming down. So the price is already dropping and bearish. Even though it's popping up here, what do we get? We get a death cross, which means be careful. There's more downside ahead. And you can see the stock gapping down and trending down once again. Also, the 200-day, as you can see, as the stock comes back up to 106, it hits its head on resistance, which is now the 200-day moving average. So it's very popular for support to become resistance. And that's really what the death cross is telling you, that once the stock is below the 200-day moving average, you've just built up more of a resistance barrier. And that's basically it. Now, if I take out the 50-day moving average and I put a shorter term one on there, like the 20-day, notice how the 20-day, the shorter term trend, is much faster than the 50. It crosses quicker. And even though it crosses here, the stock pops up and starts a short-term bullish trend and then gaps down. But still a nice death cross, a nice warning that there's more downside ahead. Now let me put this on the indexes. A really important one here is the Russell 2000, a very big index that's highly watched. Here is the 20-day short-term moving average crossing down through the 200. I've got the 20 and the 200. The 20 is a shorter term. Notice how it crosses down right here. I've got an arrow pointing at it. And let me zoom into that. That's your death cross, and that's your bear signal. Notice how it's lagging. First of all, the short-term trend has been pretty bearish all the way up until this cross. And after we get the bear signal that this is going to be more downside ahead, it's actually false. Because from this point on, look how bullish it becomes. An uptrend is actually born way before this and is taken off. So that would be a false signal. So there you have it, the infamous death cross brought to you by tackletrading.com.